Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
Who is Vinny Smile Chopra? Came to the U.S. from India with $7 in his pocket, and today he has created a portfolio of over $200 million in commercial real estate. He's a CEO of 5 companies, acquiring and managing diverse multifamily portfolio of 3,500 units, and his team self-manage all the assets. Vinny has walked the walk with over 26 successful syndications during multiple economic cycles, including downturns over 12 years. He has built a very extensive educational academy to teach and mentor investors. Vinny, tell us about this Multifamily Syndication Academy.
Thank you, Whitney. Thank you so much. I'm really proud to really talk to everybody about this extensive multifamily academy that teaches new and sophisticated investors how to use other people's money through syndications. That has been my world, to buy apartments from 50 units to 500 units, and how to select emerging markets, how to do deal analyzing, investor education, other people money, syndication blueprints. Everything I have learned, I teach in this academy, and over 500 lectures, and also how to manage the assets also, and along with lots of great templates and PowerPoints, everything. And I personally also mastermind coach all my students every Wednesday. So to reach me, Whitney, all the students have to, or investors have to, just text the word LEARN, 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 to 474747, or call my team at 925-766-3518.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is Bernard Reisz. Thanks for being on the show again, Bernard.
Thanks for having me, Whitney. It's great to be here. I'm excited about being able to provide this integrated series that should hopefully address kind of all the questions that people have, really make people educated consumers with more knowledge, more education. That's more power. And frankly, when people come to us, we want them to be educated. We want them to be asking the right questions. It makes things efficient for us when they're educated. This way they know immediately, this is for me, this isn't for me. We can get right to business rather than having to kind of start them from the ground up or, correct, a lot of misinformation they may have absorbed elsewhere on the internet.
I know I'm thankful to know somebody like Bernard, because when people start throwing out these acronyms and terms like QRP, 401k, SDIRA, UDL, all those things, I'm like, okay, where's Bernard's number, So anyway, I want to tell the guests I'm thankful to have him on the show, and we're doing this little series. So if you want to know more about Bernard, you should go back and listen to a show, WS11. He was one of our first guests, and then the show that you would have listened to yesterday, show WS181. I would encourage you to go back and listen to that one, and then also tomorrow's show, and so you can really hear all this together and just really hear Bernard explain these things that, I've had tons of questions about, and I know the listeners do as well. So Bernard, let's jump right in, and our topic for this show, and let's go at it.
Let's do this. The topic for today is primarily going to focus on the IRA space. And those are individual retirement arrangements. They come in lots of different flavors. How those can be used for real estate, equity, or debt. When those should be used, how they're used, and what are some of the things you got to be aware of when using them for real estate. And again, it's really great for people to reference prior episodes, but for anybody tuning in today to this one, let's just give them the high-level overview. Broadly speaking, tax-sheltered accounts can be used for just about any investment. The tax code, IRS, they've never dictated what you should or shouldn't invest in. There are really very, very few restrictions on what the tax code allows you to use within IRAs, 401ks, and QRPs. Tax code just wants to incentivize you to get the highest return for your long-term investing. And there are various structures that we can use. And today we'll talk about the IRAs. And IRAs, there are SEP IRAs, simple IRAs, traditional IRAs, Roth IRAs. And with regard to real estate investing, they're kind of governed by the same rules. They fall into one category. Of course, based on your particular scenario, your financial profile or your long-term expectations, the deal you're trying to do, you may choose to use one over the other. But the rules that apply to them are generally the same. At a very high level, when you use an IRA, there are a couple of different structures that you can use. And for my company, our focus is on checkbook IRAs. And if you look in the tax code for checkbook IRA, you won't find it. It's not a tax code term. It's not an IRS term. And in general, if anybody in the space tells you they're providing something that's IRS patented or IRS reviewed, you should be a little skeptical. They're very, we've got the tax code. There's certain things that are in there. There's certain structures that have been reviewed by the IRS. There's no such thing as an IRS patent. And there's actually no such thing as an IRS code. Tax code is from Congress. Congress is the legislator. The IRS kind of is the enforcer, and they kind of interpret some of the code. They may provide some regulations. So beware of anybody that tells you something is IRS patented. So when you want to get money into real estate using an IRA, how would you do that? Should you do that? So the way you would have to do it is you need an IRA custodian, somebody that's qualified to be a custodian of IRAs. Because in contrast with QRPs, an IRA requires a custodian. It's there in Section 408 of the tax code. You've got to have a financial institution that's kind of the custodian of the assets. And so you've got to find somebody that's qualified from the IRS's perspective to hold these assets. And if you go to Fidelity or Schwab or any of the other Vanguard, E-Trade, wonderful institutions, and you say, can you hold my real estate? They can't do that for you, and they don't want to do it for you. They are primarily investment exchanges. Their business model is to make money off investments. And even if there was no such thing as an IRA or a 401k, they would be there so people can trade stocks. And they make money on trades. They make money from the funds that they provide, whether it's funds that they not personally, but their business sponsors or some sort of kickback. So they're in the business of making money off investments. And they did realize that, hey, we can offer IRAs and 401ks as a way to funnel money to our investment platform. So they're in the business of providing investments. They're not in the IRA business. They do those as a marketing strategy to get money onto their platform. Now, they'll give you an IRA for free. It's never free. If you ever think you're getting something for free, you should take a couple of steps back and try to figure out how you're paying for it, because you're definitely paying for it somewhere. And it's okay. It's just if you don't know where you're paying for it, you got to be wary because who knows how much you're paying for it, because there's got to be a catch somewhere. So you're going to pay for it through your investments. And so if you want them to hold real estate, they're not set up to do that, and they don't make money on that. So they're not going to be your IRA custodian for your non-liquid, your illiquid real estate deal. So how can you do that? So there is an industry called IRA custodians, and they're in the business of custodying IRA assets. They do not provide investments. And those kinds of custodians can be used to get an IRA into real estate.
How do we know a custodian is qualified? Like, you mentioned they have to be qualified. Well, how do we know that they're qualified?
Yeah, that's a great question. The tax code does define, who qualifies. They've got to really be a state regulated or federally regulated financial institution or trust company. You can do your due diligence, kind of say, hey, let me see your charter, your state charter or your federal charter. We've got a great list on our website of 50 custodians and administrators that are active in this space.
Okay. So you can ask for those documents, or like you have that information on your website. That's
So
awesome.
we don't have those documents, but you
A
certainly
list of people
can
anyway.
request it from them. Yes,
Yeah.
we've got a great list there. Now, within that space, as you can imagine, they're doing heavy administrative work. The assets are illiquid, whereas the stock market, these exchanges are completely automated. All right, and some people, their investment strategy, it's all bots and high frequency trading. So running that is really easy, relatively easy at least. Whereas if you're dealing with the custodian in the alternative space, every deal is unique. It's not like you've got this finite world of New York Stock Exchange, NASDAQ traded investments. You know, you've got your property in Ohio. Somebody's got a property in Texas, in Africa, and somewhere in Asia. You can do just about anything. So every investment is its own set of paperwork that's got to be manually reviewed, manually processed. So that can get to be very cumbersome and costly. These custodians are there to make, it's a business and they want to make a profit, and they're providing a service and making profit on that. Well, if you're going to have like a really one-off passive investment, you just go that route. That's the best route for you. You choose which of the 50 is best for you and go for it. But if you're going to be doing multiple investments, or you have substantial assets within an IRA, then you want to explore what we call the checkbook IRA or IRA LLC. And there are a lot of benefits to that. And it's first best to outline what that structure is. And then we'll talk about, why would you want to use it? So one of the kind of investments that you can do within an IRA is private equity. You can say, hey, I've got a startup company. It's not publicly traded. I think there's huge upside potential here. And this has actually been done in some very well-known cases. Peter Thiel, Max Levchin, Mitt Romney, those are well-known and documented instances. People took advantage, put a few $1,000s into some startup company, and those today are worth hundreds of millions of dollars. So that's a really unique opportunity that you can capitalize on inside of an IRA, preferably a Roth IRA in that case. Now, just as you can, say, put it into some company that's we all recognize as an investment, and many of today's PayPal, you can put your money into PayPal at the IPO stage. Well, we can create a company for you and have the custodian move your money into that company, and you control that company. And then you direct all the activities of that company. And so say you're somebody, you want to get into multiple syndications, or you want to do tax liens, hard money loans, want to buy some gold and silver, you want to do a range of deals. Well, if you did that through the custodian, every single deal would be new fees, new paperwork, and a couple of weeks of waiting to get the paperwork approved and make sure everything was signed and T's crossed and I's dotted exactly as they need it to process the investment. It's much more efficient for you to get direct control of the money, eliminate all those fees, and be able to write the check for each investment by yourself. That cuts out, that's instantaneous investing. No weeks of waiting, no paperwork. You just do the deal yourself. And that's one of the key benefits of using the IRA LLC structure. Now, it doesn't have to be an LLC, but that's the way we generally do it. So what we do is we set up a business entity inside of the IRA. We tell the custodian, hey, we're making a private equity investment inside of this business. Once the money's in the business bank account, you have control and you can manage the investments directly. So that's the key benefit.
So what kind of timeline there? So if I had that set up already, I could invest in numerous opportunities. Just there would be no wait time. Is that correct?
No wait time whatsoever. No fees, no wait time. Ironically, you'll have the lowest fee structure and the greatest flexibility. You usually think, to get something better, you got to pay more. Ironically, you'll pay less and have better outcomes. Nice.
Okay. Yeah, I mean, because that's always an issue sometimes we run into. It's like, well, somebody wants to invest, but they've never used their IRA before for any kind of investing into real estate, and so, but, they've just got a few days to, make the investment, before the deal is either funded or, we can't accept funding anymore. And so if they had it set up ahead of time, or maybe if they could just write the checks like you're talking about, that would help them, be able to participate quicker, or make a decision faster.
Yeah, and numerous syndicators that we work with have expressed kind of this frustration with working with IRAs.
Mm-hmm.
And I think the next segment that we've got planned, we'll talk about exactly how we help syndicators and help individuals. But they'll definitely have the most streamlined and speediest investment processing if they use the structures that we set up and kind of provide the turnkey service that we give our clients to take them from 0 to 60 at the fastest rate possible.
Sounds great.
So the key benefit is really getting that control. But as we mentioned in the other prior episode, there are other reasons to use this structure, and those are some of the asset protection benefits. And there are two components to that. There's the asset protection component, where it's kind of your personal liability that you may incur. Can they go after the IRA? Or if you've got a liability within the IRA, can they go after your personal assets? So while there's a distinction between yourself and the IRA is a trust. There is, without getting into too much of the nitty gritty, the protections that are afforded IRAs are kind of state-based, and there definitely is the potential for liability to cross between yourself and your IRA. So if you're just holding Amazon stock or an S&P 500 index fund, then there's no concern about liability. But if you're buying properties, then you've got the potential for liability. So there's definitely an enhanced benefit of having a property within an LLC if you're doing it inside of your IRA to keep any kind of cross-contamination between yourself and your IRA. Beyond that, even putting aside the kind of the potential for any liability to cross one way or the other, your IRA is an investor, just so you are. And all real estate investors know that limited liability companies are a key part of their asset protection strategy. And asset protection is a kind of a highfalutin term, and I'm not a big advocate of getting too carried away with that, certainly when somebody's building a portfolio. But LLCs themselves are inexpensive. Of course, you've got to have your insurance in place. But in most states, LLCs are just a really inexpensive way to get enhanced protection. So you just do it. And if you don't do it from the get-go, then you can have trouble moving it in. So if you're in a state that's got a property transfer tax, a real estate transfer tax, in some states, even if you're going to be, moving it out of your personal name into an LLC that you own, you can get hit with the transfer tax. You can have problems with the lender. So if you want an LLC, and in most cases you should, you want to put it in there from the get-go. And an LLC provides segregation of liabilities. It means if you've got multiple properties and they're in separate LLCs, then liability can't travel from one to the other because they're distinct legal entities. If you've got 10 properties in a single LLC, well, they're all exposed to the liability of any other asset that's within that LLC. So you're looking for segregation of assets to have segregation of liabilities. Well, just as you would do it for yourself, if you're going to own multiple properties, you're going to have multiple LLCs. Same holds true for your IRA. If the IRA is going to hold multiple assets, it should have multiple LLCs. Or say you've got $500,000 in your IRA. You've got $400,000 in cash, and you've got a property that you put $100,000 into. Well, you don't want, if there's something happens on that property, you don't want them going after your cash. So you want that property, your IRA, to own that through an LLC. So when you get into real estate, your IRA is an investor, just like you would be, and it should employ all the same strategies that you would employ, and when you do employ when you invest in your own name.
So I guess help me with that structure a little bit. So, it's going to own numerous LLCs, and it may be in different states, and to really segregate the liability, of course. But so under my IRA can own many entities that are owning many properties. Is that correct?
Yeah, absolutely. The IRA is an investor. very much the same way as any other real estate investor. So you got to make the decision. Some people put multiple properties within an LLC. What kind of level of equity do you want? It's just the same considerations that you would have anytime you invest in real estate.
Good.
Yeah.
Keep us going.
Yeah, let's do it. It's a lot to think about, and kind of people, when they invest through their IRA, sometimes they overlook the fact that the IRA is an investor just as they are, and all the same considerations would apply. Well, let's talk about who should use an IRA, and what do we use to determine, who should use an IRA, who should use a QRP, and some of the rules they got to be aware of. So as we said, our first line, if we can, we want people to use a QRP 401k. Well, how do we determine if they're for the QRP or IRA is for them? It's really two simple questions. First is, do you have an owner-only business? If you have that, you're a candidate for a QRP. We're not there yet. We're not there just yet, but we're almost there. And for what an owner-only business is, you got to listen to a prior episode. The second question is going to be, and we see lots of people getting tripped up with this. Is your money after-tax IRA or Roth IRA? After-tax IRAs and Roth IRAs cannot be rolled over to a QRP. So we're dealing with people that have accumulated funds kind of in your regular plain vanilla IRA, and they want to move it into real estate. If it's in a Roth or it's after-tax IRA money, they're locked out of using a QRP for those funds. And yes, we see lots and lots of people encountering this pitfall. So those are the two things you want to think about. And if you're not a candidate for the QRP, then the checkbook IRA is the way to go. We set people with IRA LLC. They get direct control of the funds, and they can put it into as many deals and as many assets as they'd like.
Great. So QRP first, if I have an owner-only business, and then if it's not after-tax IRA or Roth IRA money, and then if so, or if I don't qualify, then I'm going to go to the checkbook IRA.
That's exactly it. And let's talk about why we do the checkbook IRA as opposed to taking a distribution, because we're also seeing lots of people that are saying, hey, I'm going to take a taxable distribution rather than use an IRA to invest. And there's kind of been misinformation about using an IRA for real estate investing, and what are some of the compliance burdens or some of the gotchas that you may encounter. The key thing, the key consideration, why we prefer QRP 401k over an IRA-based structure is UDFI, and that's the unrelated debt financed income that we spoke about in the prior episode. So we've got to kind of put that in perspective. See, what exactly is that? Why is that better than a taxable distribution? And why that shouldn't deter you from using an IRA for real estate. So broadly speaking, UDFI is the kind of income within a tax-free account that can be taxable, ironically. So these accounts that we think of as tax-free can occasionally be taxed. And the tax is called unrelated business income tax. And that was put in place by Congress in order to ensure that tax-free entities don't abuse their preferred status. So it's a kind of thing that applies to non-for-profits. So your 501c3, your non-for-profits, tax-free charitable organizations, they can encounter this tax. And IRAs and 401ks that are also tax advantaged can have this tax.
So, and it's slightly off topic, but I wanted to hit what you just said. Like a nonprofit, if they have a business inside the nonprofit, and I think I heard the example of like a church having a very successful coffee shop within the church or something like that. It's kind of an unrelated business income.
That's exactly it. And this was prompted back in the 50s which New York, Columbia University, somebody owned Mueller Macaroni Company. And they were running the company tax-free. And all the other food manufacturers, have this paying this huge tax. Everybody's biggest expense is tax. And you can imagine if you don't have to pay tax, and tax rates were far higher back then, you've got a huge competitive advantage. So anytime you've got an active business inside of a QRP or IRA, you've got the potential for this unrelated business income tax. Now, the unrelated business income tax can be incurred in a couple different ways. So one way is what we're discussing right now is that active business. If you're running a coffee shop inside of your IRA, that can become taxable. And we've got strategies to mitigate that for those of our clients that have active businesses inside of an IRA. But where it's more commonly encountered is where you use debt. So even if you've got a kind of more passive kind of investment, and say real estate, and you're borrowed money to finance the deal. So your IRA put down some of the equity and you got the rest of the funding from a lender. Well, that's called unrelated debt financed income and can result in some measure of tax to an IRA. And as we said, for real estate within a QRP 401k, you've got a carve out, an exemption. Great advantage of the 401k vis-a-vis an IRA is that it does not have the UDFI. However, if you do not qualify for the QRP, and I can't emphasize this enough, the QRP is just not the way to go. And IRA is the way to go, and there's still incredible benefit even if you encounter UDFI. Now, you can sidestep UDFI completely. A couple of strategies for that, depending on your investment strategy, your investment approach. But let's focus on people that are doing real estate syndications or your regular real estate deal, and which is going to be leveraged. Yes, some people are doing all cash deals within an IRA, but there's really no reason to all cash. Why shouldn't you get the benefit of the OPM of using other people's money within an IRA? So it's important to talk about how UDFI is calculated and what's the alternative. The alternative is either QRP that you don't qualify for, much worse results, or taking a taxable distribution from an IRA, which has also very unfavorable results. So the best bet is still going to be to go the checkbook IRA route and get into that deal. So UDFI, unrelated debt financed income. Well, the first thing you got to notice is you've got to have income. And as we all know, in real estate, you can make money without having income. That's one of the great enigmas of real estate. You can be making money, getting cash, and have no taxable income. Well, that holds true for your IRA as well. If there's no taxable income because you've got interest, you've got depreciation, you've got all the real estate deductions, well, you've got no unrelated debt financed income. So you're very likely to never to encounter it in the first couple of years of a real estate investment where you're showing a loss. That's the first thing you got to be aware of. Second component, UDFI, you get $1,000 freebie. If the UDFI, the first $1,000 of UDFI is exempt, no tax on it. So if you've got less than $1,000 UDFI, you can just ignore it. The third thing is, what are the UDFI tax rates? Now, the UDFI tax rates are not favorable. You very quickly get to the highest income tax brackets within UDFI, but that is on the rental income, which you probably won't have in the first couple of years, and you'll also have all those deductions. So that's likely to be minimal. Where you're most likely to encounter the UDFI is upon the sale of the property. Well, at the sale, the rates that apply are the capital gains tax rates. So that can be anywhere between 0 and 20%, but it's those low income tax rates. You're not going to get the UDFI rates. And I've seen time and time again misinformation about this concept. People that are kind of talking people out of using IRAs for real estate. It's a shame because on the sale, even if the UDFI will apply, and again, there are always strategies to sidestep it. It's capital gains tax rates, which are low rates. And now to get into how it's calculated and to see why it's really should never be a deterrent. When you put equity into the deal and then you use a portion that's leveraged, the UDFI tax it only applies to the extent that there is leverage. So if it's a $1 million deal and you put in $250,000 from your IRA, $750,000 or 75% of the money is borrowed. It's a bit of an oversimplification of how UDFI is calculated, but it is proportionate to the amount of money that is borrowed. So the 25% is tax-free forever. Well, not forever, depending it's Roth or traditional. But your equity portion, the amount that you put into the deal, the amount that you had in your IRA for the equity, that does not get taxed. So that remains tax-free, and it's like, hey, you can have $25,000 of mutual funds, or you know, you can have 25%, whatever that may be, 250K of mutual funds, or you can get $1 million of real estate using the same 250,000 and pay tax on the 750 and that 75%, which is OPM. I mean, it's a no-brainer. Go for the real estate. You get the OPM, you get the bank's money, and you get all the real estate deductions. So you probably have no taxable income at all, even with the UDFI first couple of years. And even if you do encounter, if and when you do encounter it, it's tax on the OPM. So it's on the leverage portion. So you take as much leverage as you can. And if you've got income on that, I mean, that's kind of free money anyway, because it's the banks. So it should never be a deterrent. What do you say about all that, Whitney?
I say we're almost out of time. And so I wanted to tell you, in case there's a few things that you really need to let the listeners know about before we have to cut this episode off.
Yeah. Let's talk for a moment about the alternative. Taxable distribution. What happens there? So say you've got this money in the IRA and you're thinking, you know what, I just want to pull it out. Now, if you take a distribution from the IRA, here's what happens. It becomes ordinary income to you. So depending on your marginal income tax rate, you're going to pay that as a base just to begin with. And if you've got a substantial IRA, you've got to think about not the income tax bracket that you're currently in. You've got to think about which bracket it's going to push you into. So if you've got a $500,000 IRA and you take a distribution, you're likely going to be paying between state and federal off the bat, depending on which state you're in, you're going to be paying close to 50% because it becomes ordinary income. And then you can lose all sorts of other tax deductions that you have. You may have certain credits, all sorts of stuff. It can do all sorts of wonky things to your tax return if you've got an unexpected windfall of $500,000. Beyond that, you're going to pay an additional 10% penalty. So if you take a taxable distribution from your IRA, you're likely to give, depending on where you fall, in terms of taxable income, between 30 to 60% of that to the taxing authorities. So you're starting off, if you had $500,000 to invest, well, you're going to end up with somewhere between $200,000 to $250,000 of investable assets. Well, think about the difference initially and over time of investing $500,000 or investing $250,000. The difference over time is worth millions of dollars. As you know, you could begin with your principal and it compounds over time. If you do that, if you start with a much lower principal amount, and if each year thereafter you're paying tax on your gains, compared to starting off with $500,000 and investing that tax-free or tax-deferred for a couple of decades, that is worth millions and millions of dollars. So to recap, preferred structure, QRP, if you qualify. Secondary, get into the checkbook IRA. Last resort, which nobody should ever have to resort to because you can always use either the QRP, 401k, or the IRA, is a taxable penalty-laden distribution.
Wow. Thank you so much, Bernard. It's in these shows like this, just prove to me again why a team is so important and why having somebody like yourself that's an expert, in these matters that seem complicated to some, to us that, we're not in that every day. It seems complicated, but I appreciate, someone like yourself that can just lay it out, more layman's terms, I guess, or, where somebody like myself can say, okay, I know Bernard said this and I should be thinking about this. And ultimately it's going to lead to, calling you to say, confirming maybe what I think or pointing me in a different direction.
Yeah. And what we like to say, we'll give people all the time in the world that it takes. Way we like working with clients is, we are we're committed to getting you into the plan that's best suited to you. It sometimes takes some time and discussion to sort that out. We like saying, hey, we know where we're going to put your interest first. We get started on an engagement. Our pricing is transparent. It's low. It's super competitive. But if you're committed to working with us, we're committed to giving you all the time it takes, or potentially even to restructure you if you'd like to go that route, to fit you into the plan that will get you the best outcomes.
Great. Bernard, tell the listeners how they can get in touch with you.
Yes, check us out at 401kcheckbook.com. That's 401kcheckbook.com. No hyphens, no dashes. Love to see you there. You can click and schedule a meeting with us. You can go through all the info we've got there. Lots of helpful info. We want everybody to be educated, and we look forward to assisting you.
Awesome. Well, I hope the listeners will go to Bernard and ask these questions of him and partner and, make sure you're setting this up correctly with an expert like himself, and go to Life Bridge Capital and connect with me. I'd love to have a phone call with you if you are looking at investing in real estate, of course, and partnering with us. And in many ways you can do that, but and go to the Real Estate Syndication Show on Facebook. And so you can discuss and ask questions with other experts like Bernard and people in the industry, and we can all grow our business together. Look forward to seeing you there and talking to you soon. And as far as the show, we'll talk to you tomorrow.
Whitney, thanks for having me.
Thank you for listening to the Real Estate Syndication Show, brought to you by Life Bridge Capital. Life Bridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. Life Bridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.